Well, this doesn't help. South Africa still coming to terms with the unexpected contraction of the economy in the second quarter of this year. The contraction reported yesterday may deter the Reserve Bank from raising interest rates. Of course, higher rates mean it's more costly for consumers to take on debt. That means less spending, which usually dampens price increases. But the bank is still trying to fight inflation that is picking up. Eitherway, Stanlib's chief economist, Lings, says now is not the time to take on more debt.
Lings says the Reserve Bank will be cautious in how it approaches interest rates. Inflation is worrying and needs to be kept within the 3 to 6% target range. In an effort to contain inflation, last month the bank raised its benchmark repurchase rate by 25 basis points.
I think the Reserve Bank going forward will try and keep interest rates fairly low for as long as possible, and I don't expect that we necessarily see regular hikes and maybe not even a hike again this year.
But consumers are under significant pressure due to rising costs. Added to that, threats of job cuts. Lings warns consumers against overcommitting themselves financially.
It's not time to take on a significant amount of debt. It's time to make sure that there is job security, and it's time to recognize that perhaps consumers need to look at other ways in which they can supplement their revenue. Can they find part-time work, etc.
The latest GDP figures show that the economy contracted by 1.3% in the second quarter. This does not bode well for an economy that has been on ratings agencies' watch lists. However, Lings says South Africa is unlikely to be downgraded. He says for the moment, they're likely to warn South Africa about the risks, but will take a while before they change the rating. SABC News, Johannesburg.